Right, so thank you, Roland. Thank you also, Laith, very interesting presentation. So I appreciate the opportunity to talk about Alliance Trust, what we do and why we think Alliance Trust can help investors build their retirement nest egg. Laith gave us a lot of background there as to some of the challenges in investing in the markets today, some of the opportunities as well. Hopefully we'll give you an idea of why Alliance Trust is quite well suited to help people navigate through difficult environments. I'm going to start off with simply the objective of Alliance Trust. So I'm the co-portfolio manager of Alliance Trust. I work with Willis Towers Watson. We took over the portfolio, running the portfolio for Alliance Trust in 2017. And when we did that, we sat down with Alliance Trust and talked about their objective and talked about the strategy we devised to help them meet this objective. So I'll break this down quite simply in the sense that the trust objective is to be a core investment. By that, we think the trust can be a large part at the center of people's portfolios, the kind of portfolio that you can hold for long periods of time and just add capital to it month after month and just compound that wealth over long periods of times, if not generations. Alliance Trust strapline is investing for generations. Then it's talking about delivering a real return. So by real return, we mean ahead of inflation and over a long period of time, as I've discussed. And we do that through a combination of capital return and a rising dividend. So here we mean that we're trying to maximize your total return in the long term. But that total return is going to be made up of capital growth and dividend growth. And Alliance Trust uses the strength of its position as well as its investment trust structure to ensure that it can smooth dividend flow and pay you a rising dividend year after year, as it has done for the last 56 years. So I'll talk more about the dividend a bit later on. But that's essentially what the trust is trying to do. It's trying to be a core part of the portfolio, compound that wealth over long periods of time, help you build that retirement nest egg, and deliver those returns to shareholders. So how do we do this? These are the pillars of our strategy. We've got 6 key pillars to what we do. Now, one of Laith's slides was talking about passive and active. And we've seen how challenging it's been for active managers recently, and a lot more flows going into passive. And that's interesting, and it creates a few dynamics. But for us, one of the starting points we have is we want to do something different. When we started running the portfolio with Alliance Trust, we didn't want to just produce the same kind of thing that everyone else does and hope to convince people that we can do it a little bit better. We wanted to do something different to help meet this objective for our shareholders. And what I mean here is once you move into this active space, you better have a competitive advantage. So the 2 key pillars for us are high conviction and diversification. So what do I mean by these things? Well, the competitive advantage that we think equity investors have is their company analysis and their stock selection. Those are the things which we think you can find skilled investors, and we think that skill is repeatable over long periods of time. What we don't think they can do is time macro environments, time markets, time styles. All of that macro context is incredibly important when picking companies. Laith talked to you about the valuations in the UK market, the US market. Those are very important things to be aware of. But just making a few small decisions about big macro events is a very, very difficult way of making money. So we focus on company analysis. And how do we maximize the returns we can get from stock picking skill? Well, what we do is we customize portfolios. We ask our stock pickers to customize and just give us their maximum of 20 best investment ideas. And that's very different from a normal global equity product that might have 40 or maybe 50 stocks. Some have 100 or more stocks. And we're frankly not that interested in their 99th or 100th best idea. We really want to maximize the capital that we've got exposed to their highest conviction, top 20 ideas. And that should give us better long-term total returns. Now, the challenge, of course, is that these concentrated portfolios can be very volatile. So if you think back to the objective that we want to be a long-term core holding for our shareholders, it's quite hard to be a core holding if it's very volatile, because people find it difficult to hold volatile positions. And worst thing of all would be if they sell it at the wrong time. And that's where we move into diversification. So our second pillar is we run a multi-manager structure. We've selected 10 stock pickers today, Could be a few more, could be less, but it's 10 today. And we specifically choose them such that they are very different in what they do. They've got different philosophies, different approaches, different ways of thinking about investing, and that leads into different ideas. And it's those different ideas that have different payoffs at different times. And all of those things give us the diversity. So the combination of these two pillars really gives us what we think is a double whammy effect of higher expected long-term total returns from high conviction stock selection, and better resiliency, better diversification from having 10 stock pickers, all with different types of ideas. I'll run through the remaining pillars quite quickly. Competitive costs. Obviously, there's no good coming up with a great strategy if it's far too expensive and eats away all the returns. So we deliver this strategy at competitive costs, at or below what you'd expect to pay, I think, for a normal, in quotes, normal global equity strategy. And we do that by leveraging Willis Towers Watson's sort of global brand, global presence. So we work with institutional investors around the world. We advise investors with trillions of dollars of capital. We manage $160+ billion of capital ourselves. And we use this global scale to drive costs down and deliver this strategy at a very compelling cost for our shareholders. On the bottom left, we talk about exclusive access. And by this we mean, given our global scale and global reach, we can bring really exciting stock pickers from around the world to UK retail investors. So some of our stock pickers you won't be able to access as a UK retail investor. Some of them you can, some of them will be names you recognize, but even then you cannot access their customized, concentrated best ideas portfolios that we have in the Alliance Trust. Sustainability is clearly key to everything that people do nowadays. We could probably spend all day talking about sustainability, so I'll try and do this in 30 seconds, which is to say, we are investing in businesses for the long term. If you think about investing in companies, we just have to recognize that what goes on in the world and the environmental, social, governance risks, ESG risks that people talk about, these are things that affect companies. They affect people, they affect societies. They are risks, they are opportunities. And we just have to be aware of all of these things when we're selecting companies and thinking about their valuations. So we integrate ESG and sustainability into everything that we do. And we want to act as responsible investors. So we take our stewardship very seriously. It's clearly a privilege to be a steward of other people's capital, and we make sure we've got good governance processes, good engagement with stock pickers, with companies, and we make sure we vote our proxies in a sensible and long-term way that's in your interests. Finally, dividend growth. As I mentioned before, Alliance Trust has a 56-year history of raising its dividend every single year, and that demonstrates the sort of the strength of Alliance Trust, the advantages of the investment trust structure. So Alliance Trust now pays an attractive dividend and a rising dividend through time. And the board is very committed to that strategy, and we know that our shareholders have been very appreciative of that dividend growth over long periods. So that's the strategy overall. I'm just going to move through a few of these slides a little bit more quickly now. So this is the structure of the portfolio today. Firstly, just like to point out, you can see the stock pickers in the portfolio. Again, some names you might recognize, such as Jupiter. We use Ben Whitmore at Jupiter in this portfolio, but hopefully some names that are less familiar to you. To give you a quick idea of some of the diversity, we have managers like Sustainable Growth Advisors there on the left, and the clue is obviously in the name. They're looking for sustainable growth companies, companies with really embedded competitive advantage that enables them to grow either faster than average or for longer than the market is expecting, because they've got some sort of IP or some barrier to entry that's enabling really high quality product to grow faster for longer. Then you might have other managers like a Lyrical, say, at the bottom. Lyrical's more of a value manager who's looking at deeply discounted companies. They start off with just what are the cheapest companies across the market as a whole. And then, of course, throw out all the ones that are cheap for a reason. And they're looking to find, if you like, the diamonds in the rough that are great companies that have had some issues, become excessively cheap because of sentiment rather than any fundamental issue, and expecting those companies to recover and deliver really strong returns from a very low valuation starting point. So these strategies clearly very different. different types of businesses in there, different ideas in the portfolio. And that's really what we mean by the resiliency of this multi-manager stock picking structure. Final point on this slide is you can see the allocations, which are clearly not equally weighted. We think all of these managers are excellent at what they do. We have, simplistically, equal conviction in their abilities, but they're not equally weighted. And that's because myself and my team with co-manager Mark Davis and our CIO Craig Baker, our job is to sit down and put the portfolio together and think about the total portfolio and the risk exposures. And what we're trying to do is allocate capital to these stock pickers such that it's stock selection risk which is really driving the returns, and these sort of broad macro factor risks are minimized as much as possible. So for example, you can see Sands in the bottom left there at about 4% of the portfolio. They have a low allocation because they are focused on very high growth companies. And as I'm sure people know, it's been a very, very volatile area of the market recently. So that has had a lower allocation because it's been a lot more volatile. So the impact on the portfolio is higher if they had more capital. So their allocation is lower. And then you've got managers like Veritas who focus on larger cap, high quality, more stable cash flow companies. They have a higher allocation so that they have a more stable portfolio structure. Their contribution is quite similar to Sands, even though they've both got different weightings. So we know that the world changes. We know that portfolios change through time, and our job is to make sure that we keep evolving the portfolio structure to make sure that it is delivering the stock selection skill that we expect it to. And just to give you a little bit of a proof point of this, this is the structure of the portfolio, and we're trying to show that from a top-down perspective, the portfolio looks quite similar to the market. So this is what I mean by saying we're not trying to take these big market risks. So if you look at the sector exposure and the geographical exposure, the portfolio in purple versus the benchmark in gold, you can see that we're not identical to the benchmark. We don't need to be overly precise about that. But you can see that we have broad exposure and our position relative to the markets are pretty small. Same thing for the styles in the top left. These are style tilts relative to the benchmark. And you can see that simply all of these numbers are quite close to zero. So we don't have a bias towards value stocks or growth stocks. We're quite balanced in our overall structure. This is all very intentional. So key is on the top right, of course, that our stock selection structure of the portfolio is very different to the benchmark. Benchmark has around 3,000 companies. We've got around 200 companies in the portfolio where every single one of them is one of our stock pickers' highest conviction investment idea. We've got 74% active money. That means it's a very active portfolio from a stocks perspective. By active money, I mean how much of your money is invested actively versus the benchmark. So if you're passive and you simply own the whole benchmark, your active money is zero. If you don't own anything in the benchmark at all, your active money is 100%. So 74 is very, very high for a multi-manager strategy such as this. And this whole slide is just trying to demonstrate that top-down perspective, the portfolio looks like the market. From a bottom-up perspective, it's completely different to the market. And that selectivity of how we pick the stocks is key to delivering value. So how has the strategy been doing? We've shown the returns in absolute numbers across the top here, total shareholder returns and the NAV returns. Since we've been running the strategy 2017, 6 or so years now, clearly compounded pretty strong levels of return in an absolute basis. And then we've also shown relative to various comparators underneath it. So relative to the benchmark, relative to the investment trust peer group, which is the AIC global sector, and then relative to a wider peer group, which is the Morningstar global sector, which includes investment companies and also open-ended companies. I think what's really important for me is, versus these comparators, depending on which comparator and which time period you pick, the performance has been strong, across all of these periods. And Leith was talking about some of the things that have been happening in the marketplace. There's been a lot going on. And these rapidly start to sound like excuses when people talk about these things. But if we can simply observe that we've had COVID, we've had enormous stimulus that we haven't seen since the Second World War. You've had interest rate rises to take that stimulus away. You've had wars in Europe, wars in the Middle East. You've had passive flows, which have been of a challenge for active managers. It has not been a great place to be a stock picker. But when you think about our objective that we talked about at the start of being a core holding for our shareholders through long periods of time, to deliver value through stock selection, even though we look at all the macro things that have been happening to the world in the last 6 or so years, the strategy really has been delivering. It's been delivering its returns, and it's been doing it in a diversified and stable way. So even when we've had swings from growth to value and to tech to energy and so on, the portfolio's just managed through that and outperformed a number of its peers through that time. So it really speaks to the strategy and how it delivers over longer periods. Just getting conscious of the time now, so I'll just quickly talk about outlook and wrapping up the presentation. So our outlook, I think there's nothing particularly unique in our broad perspective on the market. I think we're cautious of the markets overall. Macro risks are still high. I think that's fairly obvious. Uncertainty is high. And markets overall are not cheap. And Laith was describing some parts of the market might look cheap, some look more expensive. I'm sure that's always going to be the case. There's always going to be some parts of the market that are cheaper than others. But making those macro calls is difficult. So our view is that markets, there's lots of risks around. They're not cheap overall. So we're a bit cautious, which means our gearing is lower than it might typically be. Our typical gearing is 10%. We're near a 7% gross gearing today. But our outlook for the portfolio is really optimistic. With a true cost of capital now, with interest rates where they are today, we're seeing a lot of sifting out of winners and losers between companies. And that really plays into the strength of stock pickers. So returns, like I said, have been strong recently. And we think over the long term going forward, there's plenty of potential for stock pickers to add real value in this type of environment. A very quick note on the dividend. As I mentioned this before, you can see the history here. Alliance Trust is an AIC dividend hero. It's one of a very small number of companies that has raised its dividend every year for 56 years. And you can see recently, actually, that the board has decided to raise the level of dividend quite significantly as well. So Alliance Trust now pays quite an attractive dividend level of dividend, but also gives you the benefit of growing that dividend through time because of the strength of Alliance Trust position and the strategy that it has. Just in summary, before I hand back or hand over to our next speaker, I just wanted to sort of reiterate the strategy that Alliance Trust has for helping investors reach their goals of building their retirement nest eggs or any other goal they have for building generational wealth. It's a high conviction portfolio that is expected to deliver returns, but it does it in a diversified and resilient sort of way. It gives you that global exposure, so you don't have to spend all your time thinking about and stressing about which part of the market should I own this year or next year. We have broad exposure across all the markets, but we're being very, very selective about the types of companies we pick and the opportunities that they give you as a shareholder. Clearly, we've talked about the performance and how the multi-manager structure delivers this strategy through time. Performance has been strong. We expect that to continue over the long term. Clearly, it won't continue in a straight line, but we think that performance is really quite compelling in this environment. Very quick note on the discount. We've seen discounts across the whole investment trust sector widen out quite a lot recently, largely as a result of interest rates rising, as well as other issues, of course. Alliance Trust discount, has been quite stable, around 6%. Again, that's speaking to the strength of Alliance Trust and its brand and how it's delivered for its shareholders. So it's really protected people from the downside and some of the volatility that you might see in the discounts. And finally, like I said, just delivering all of this at lower costs as we can. So we think at about 0.6% OCR, ongoing charges ratio, we think is a very competitive fee for a diversified multi-manager high conviction strategy such as this.